A $40,000 IRA withdrawal. That's it, one distribution. And when the tax math settles, that single withdrawal creates $64,150 in new taxable income. Not $40,000, $64,150. Because the withdrawal doesn't just get taxed, it reaches into your Social Security check and drags $24,150 of previously untaxed benefits onto your tax return with it. That number sounds wrong. It's not. And it's only one of 5 tax traps wired into the withdrawal side of every traditional 401k and IRA in America. 5 traps that don't sit there independently. They trigger each other. One fires, the next one gets worse. By the end of this video, you'll see exactly how the cascade works and what moves you can still make to stop it, even if you're already deep into required minimum distributions. If this is the kind of thing your financial advisor never warned you about, subscribe now so the next one doesn't catch you off guard either. You did everything right. For 30 or 40 years, you put money into that 401k every paycheck. You got the employer match. You picked your funds. Every HR rep, every magazine article, every coworker at the lunch table said the same thing. Max it out. It's pre-tax money, and when you retire, you'll be in a lower bracket. You listened. You were disciplined. And for 62% of Americans over 65 who own a retirement account, that advice is now colliding with a reality nobody explained. The lower bracket in retirement story was not wrong exactly. It was incomplete because the compounded growth inside that account, the thing that made it work, created a mandatory taxable income stream you never planned for. And the withdrawal side of the tax code is more punishing than anything the accumulation side ever hinted at. So here's what we're going to do. I'm going to walk you through 5 specific traps embedded in 401k and IRA withdrawals, in order, each one worse than the last. Then I'll show you the mitigation strategies that exist for each one, including options that work after you've already started taking required distributions. If you're sitting there thinking, it's too late for me, stay with me. It's not. Trap 1. Every dollar you withdraw from a traditional 401k or traditional IRA is taxed as ordinary income. Every cent. Doesn't matter if that money sat invested for 35 years. Doesn't matter if the gains inside the account would have qualified for long-term capital gains rates in a brokerage account. The IRS treats the entire withdrawal, contributions and growth as ordinary income. No preferential rate, no discount for patients. Think about what that means in dollars. If you'd held the same investments in a regular brokerage account, most of those gains would qualify for long-term capital gains, 0% or 15% for most retirees. Inside a traditional IRA, those same gains get taxed at 22% or 24%. The account that was supposed to save you money on taxes is now charging you a higher rate than the account with no tax benefit at all. That's the first thing nobody mentioned on the way in. Now, 14 states don't tax these withdrawals at all. The 9 states with no income tax, plus others like Illinois, Pennsylvania, Mississippi, and Iowa for those 55 and older. And if you live in Florida or Texas, you might think you're in the clear. You're not. The state exemption doesn't touch federal taxes. Every dollar still gets taxed by the IRS. Let me put numbers on this so it's real. Take a married couple, both 75. They've got $1.6 million in IRAs. Their required minimum distribution is about $65,000. Add $45,000 in Social Security. After the provisional income formula runs, about $38,000 of that Social Security becomes taxable too, bringing their adjusted gross income to roughly $103,000. Subtract the $32,200 standard deduction and the $12,000 senior bonus deduction from the one big beautiful bill, and their taxable income lands around $59,000. That keeps them in the 12% bracket, but barely. The 22% bracket starts at $100,801 for a married couple. That means they've got about $42,000 of room. One extra withdrawal, one small Roth conversion, a part-time consulting check, any of it eats into that cushion. And the market decides too. If their IRA gains push next year's RMD higher by $20,000, the Social Security inclusion rides along and adds another $17,000 in taxable income on top of it. $37,000 in new taxable income from a $20,000 increase. The margin is thinner than most people realize, and that's just the starting point, because at a certain age, you don't even get to decide how much you pull out. The government decides for you. Trap 2. Required minimum distributions. At 73 or 75 if you were born in 1960 or later, the IRS tells you how much to withdraw from your traditional accounts every year. Not a suggestion, a requirement. You take your account balance on December 31st of the prior year, divide it by a factor from the IRS Uniform Lifetime Table. At 73, that factor is 26.5, and whatever number comes out, you withdraw it and pay income tax on it, whether you need the money or not. On a $500,000 IRA, your first RMD is $18,868. That's manageable. But on a $1.5 million IRA, it's $56,604. And on $2.5 million, $94,340 a year. That's $7,862 a month the government forces you to withdraw and pay taxes on. There's a trap within this trap. Your first RMD can be delayed until April 1st of the year after you turn 73. Sounds generous. But if you take that delay, your second RMD is still due by December 31st of that same year. 2 full RMDs in one tax year. Double the income spike. Double the bracket damage. And if you miss an RMD entirely, the penalty is 25% of the amount you should have taken. Secure Act 2.0 dropped it from 50%, so that's progress. But 25% on top of the income tax you already owe is still brutal. The part that makes this a trap and not just a rule. RMDs grow as your account grows. A strong market doesn't just increase your wealth, it increases the amount the government forces you to withdraw next year. The trap tightens over time. Now, if forced withdrawals were the only tax problem, it would be manageable. But your RMD triggers something else, something most people don't discover until they get a letter from Social Security 2 years later. Trap 3. Your withdrawal makes your Social Security taxable. There's a formula called provisional income. The IRS takes your adjusted gross income, adds any tax-exempt interest, then adds half of your Social Security benefits. If that total crosses $25,000 for a single filer, or $32,000 for a married couple, your Social Security benefits start getting taxed. Cross the upper threshold, $34,000 single, $44,000 married, and up to 85% of your Social Security becomes taxable income. Those thresholds were set in 1984. They were designed to catch the top 10% of Social Security recipients. They have never been adjusted for inflation, not once in 42 years. Before the One Big Beautiful Bill passed in 2025, they were catching roughly half of all beneficiaries. The new senior bonus deduction has temporarily lowered that share, but the thresholds themselves haven't moved, and anyone with a sizable IRA still gets caught. And here's the mechanism that makes this a trap instead of just bad policy. When your provisional income is in that 85% phase-in zone, every additional dollar you pull from your IRA doesn't just add a dollar to your tax return. It makes 85 cents of your Social Security benefits taxable too. So on a 12% nominal bracket, your effective rate on that one IRA dollar is actually 22.2%, nearly double what you thought you were paying. This is where that opening number comes from. A $40,000 traditional IRA withdrawal pushes provisional income to $55,000. That makes $24,150 of previously untaxed Social Security suddenly taxable. The withdrawal itself, $40,000. The Social Security it dragged onto your return, $24,150. Total new taxable income from one distribution, $64,150. 40 became 64. And your IRA statement never showed you that second number. But there's a third layer. Your IRA withdrawal isn't just making your Social Security taxable, it's also raising your Medicare premiums, and you won't find out for 2 years. Trap 4. IRMAA, the Income-Related Monthly Adjustment Amount. Medicare's invisible surcharge. Your Medicare Part B premium in 2026 is $202.90 a month. That's the base rate. But if your modified adjusted gross income from 2 years ago, 2024 in this case, crossed certain thresholds, you pay more. How much more depends on where you land. For a single filer, the first cliff is at $109,000. $1 over that line, $109,001 of MAGI, and your Part B premium jumps to $284.10 a month. That's an extra $81.20 every month. Plus Part D adds another $14.50. Total damage from $1 over the threshold, $1,148.40 for the year. Not on the dollar, on the year. And it's a cliff, not a slope. There's no gradual increase. You're either under the line or you're paying the full surcharge for all 12 months. The tiers keep climbing. At the top, a single filer pays an extra $578 a month, $6,936 a year in surcharges alone. A couple at the highest tier, $13,872 a year on top of the base premium. About 7% of Medicare beneficiaries, roughly 5 million people, get hit by IRMAA. And most of them didn't see it coming because of the 2-year look-back. You take a large IRA withdrawal in 2024, maybe a Roth conversion you thought was smart, maybe an RMD that was larger than expected, and in 2026, a letter arrives from Social Security telling you your Medicare premium just doubled. The cause happened 2 years ago. By the time you find out, there's nothing to undo. Here's what that looks like in practice. Say you're 66, recently retired, and you decide to do a $150,000 Roth conversion in 2024. Smart move in isolation. But your MAGI for 2024 now lands around $160,000. That's Tier 2. Your Part B premium in 2026 jumps to $405.80 a month. Part D adds $37.50. Total IRMAA surcharge, about $2,885 for the year, $2,435 from Part B, plus $450 from Part D. You did the conversion to save future taxes, and 18 months later you get a bill you never factored into the math. That letter from Social Security? That's the IRMAA determination notice. And for a lot of retirees, it's the first time they realize their retirement account and their Medicare bill are connected at all. Now, this is where the real damage happens. These traps don't operate alone. Each one feeds the next. Let me show you what happens when they all fire at once. Start with a single retiree, 73, with a $2.5 million traditional IRA. Their RMD is $94,340. They also receive $24,000 in Social Security. Trap 1 fires. The entire RMD is ordinary income. Trap 2 already fired. The government forced the withdrawal amount. Now Trap 3. Provisional income equals $94,340 plus $12,000, half of Social Security, which is $106,340, well above the $34,000 threshold. 85% of Social Security, $20,400, becomes taxable. Total adjusted gross income, $114,740. A $20,000 increase in RMD doesn't create $20,000 in new taxable income. It creates $37,000 because the Social Security inclusion rides along with it. And Trap 4, their total MAGI, $114,740, crosses the $109,000 IRMAA cliff. 2 years from now, $1,148 a year in new Medicare surcharges. 4 traps, 1 withdrawal, each one making the next one worse. And then there's Trap 5, the one nobody warns you about until it's too late, the widow's penalty. When a spouse dies, everything about your tax situation changes for the worse. You go from married filing jointly to single. The 22% bracket, which started at $100,801 for a couple, now starts at $50,401, less than half the room. The IRMAA threshold drops from $218,000 jointly to $109,000 single, exactly half. Take John and Mary. Filing jointly at $135,000 in income, they pay the base Medicare rate, $202.90 a month each. John dies. Mary's income drops to $110,000. She's earning less money, But as a single filer, that 110,000 crosses the $109,000 IRMAA cliff. She now pays Tier 1, $81.20 more a month in Part B, $1,450 more in Part D, $1,148.40 a year in new surcharges, on less income than before. A widow with $80,000 in taxable income pays roughly $3,200 more in federal taxes than she would have filing jointly on that same income. Less money, more taxes, higher Medicare premiums, and all of it lands at the worst possible moment in her life. The tax code doesn't have a grace period for grief. If you're watching this and feeling like there's nothing you can do about any of it, that's exactly the feeling these traps are designed to produce. But there are moves, even now. Strategy 1. Roth conversions in the gap years. Between retirement and the start of RMDs, typically the years from 62 up through 72 or even 74, depending on your birth year, you're often in the lowest tax bracket of your life. Earned income has stopped. Social Security may not have started yet. RMDs haven't kicked in. This is the window. A married couple with no other income in 2026 can convert roughly $133,000 from a traditional IRA to a Roth and stay inside the 12% bracket. Every dollar you convert now comes out of the future RMD calculation permanently. It also permanently leaves the MAGI that Medicare uses for IRMAA. So the conversion shrinks your forced withdrawals, which means less Social Security gets taxed, which means IRMAA stays off your back. One move, 4 traps neutralized. The key is the word permanently. A dollar you convert at 12% today never shows up as a dollar you're forced to withdraw at 22% later. It doesn't compound the problem year after year. It's gone from the trap machine for good. Strategy 2. Qualified Charitable Distributions, QCDs. If you're 70 and a half or older and you give to charity, this is the single most powerful tool available to you. In 2026, you can direct up to $111,000 per person, $222,000 per couple, straight from your IRA to a qualified charity. The transfer satisfies your RMD, and here's what matters. The money never appears as income on your tax return. It doesn't hit your AGI. It doesn't touch provisional income. It doesn't feed IRMAA. The distribution happens, the RMD obligation is met, and the tax cascade never fires. There's also a one-time option most people don't know about. You can transfer up to $54,000 from your IRA to a charitable remainder annuity trust. It satisfies your RMD for that year, and the trust pays you back an income stream, like a pension, for life. One transfer, one charitable gift, and a new income source that doesn't carry the same tax cascade. This works after RMDs have started. If you've been telling yourself it's too late, this is your answer. Strategy 3. Bracket filling. In any year where your income is unusually low, deliberately withdraw from your traditional IRA up to the top of the 12% bracket. $50,400 for a single filer, $100,800 for married filing jointly in 2026. You pay 12% now instead of 22% or more later when RMDs force the money out at higher income levels. You're choosing when and how much to pay rather than letting the RMD schedule decide for you. Strategy 4. IRMAA look-back planning and the SSA 44 appeal. Know the cliffs. Time your large withdrawals and Roth conversions so they don't land in a year that will spike your Medicare premiums 2 years later. And if something happens that drops your income, retirement, job loss, or a spouse's death, file SSA Form 44 immediately. Death of a spouse is one of 8 qualifying life-changing events. Social Security will use your current income instead of the 2-year-old number to recalculate your premium. That can eliminate an entire surcharge tier overnight. Strategy 5. Withdrawal sequencing. The traditional approach. Draw from taxable brokerage accounts first, then traditional IRA and 401k, then Roth last. Let the Roth keep growing tax-free as long as possible. The dynamic alternative? Pull from traditional accounts in low-income years to fill brackets cheaply, and switch to Roth in high-income years to keep your MAGI under control. Tax inefficient sequencing. Pulling from the wrong accounts in the wrong years costs retirees 5 to 15% of their after-tax wealth over the course of retirement. The order matters. Remember that $40,000 withdrawal that became $64,150 in taxable income? Now you know exactly how that happens. Ordinary income taxation, forced RMDs, provisional income thresholds frozen since 1984, IRMAA cliffs with a 2-year fuse, and a widow's penalty that punishes the surviving spouse for being alone. 5 traps, each one feeding the next. But you also know the 5 moves that can disrupt the cascade. Roth conversions before RMDs start. QCDs that satisfy your distribution without a single dollar hitting your tax return. Bracket filling in low years. IRMAA planning with the SSA 44 as your safety valve. And sequencing your withdrawals so you're pulling from the right accounts at the right time. The people who understand how these pieces interact are the ones who keep more of the money they spent 40 years saving. If you know someone heading into retirement with a 401k, send them this video before they take their first withdrawal. And if you want the deep dive on Roth conversions, exactly how much to convert, which years to do it, and how to stay under the IRMAA cliffs, that's coming next.